Something happened this week that most people completely missed. While everyone was watching their stock portfolios bleed out, while everyone was glued to headlines about tariffs and trade wars and which politician said what, a quiet transfer of wealth was already underway. Not tomorrow, not next month, right now. And if you're watching this channel, you're already ahead of 99% of the people who have no idea what's coming. If this kind of information matters to you, hit that subscribe button on SHF Money right now and give this video a like so more people can see what's actually happening. Because what I'm about to break down changes everything about how you should be thinking about your wealth in 2026. Let's talk about silver first. Right now, silver is sitting at $87.95 per ounce. That's up $2.86 in a single day. A 3.38% move in one day. Gold is sitting at $5,220 per ounce. Up over $100, more than 2% in one day. These are not small moves. These are not normal market fluctuations. This is the market telling you something. And the people who understand what that signal means are positioning themselves right now while everyone else is still asleep. But here's where it gets even more important. The gold-silver ratio has just crossed a critical threshold. The ratio is now under 60 to 1. That means it takes fewer than 60 ounces of silver to buy 1 ounce of gold. Why does that matter? Because historically, when this ratio drops, it's a sign that silver is beginning to close the gap with gold. Silver is waking up. And when silver wakes up, it moves fast. The ratio dropping below 60 is not just a number, it's a signal that the smart money has been waiting on. The strategy shifts when the ratio crosses that line. Below 60, you stop splitting your attention between gold and silver equally. You start focusing on gold. And if the ratio keeps dropping toward 40, toward 30, that's when you start considering swapping silver positions into gold. That move has been made 3 times already this cycle when the ratio was down in the 40s. The opportunity may come again. Pay attention. Now let's talk about why all of this is happening. Because it doesn't happen in a vacuum. There is a direct cause. Trump raised global tariffs from 10% to 15%. That's not a small adjustment. That is a structural shift in how global trade works. And one of the stated goals of this policy is to weaken the US dollar. Look at the dollar index right now. It is down sharply. When the dollar weakens, real assets move up. Gold moves up, silver moves up. This isn't theory. This is what you're watching play out in real time. The dollar is being deliberately weakened, and gold and silver are responding exactly the way they always have when fiat currency loses purchasing power. And it's not stopping. The tariff situation is escalating. Any country that tries to play games, any country that has been taking advantage of the existing system for years or even decades, is going to face even higher tariffs. That's the message being sent. Buyer beware. That's the exact language being used. This means more uncertainty, more volatility. And when there is uncertainty and volatility in currency and trade, money flows into hard assets. It always has. Gold and silver have been stores of value for over 5,000 years. 5,000 years. No government, no bank, no central planner has ever successfully destroyed the value of gold and silver over the long term. They've tried. They've always failed. Now here's the question everyone in the precious metals community has been asking. Do tariffs apply to gold and silver? The answer is no. The White House fact sheet specifically exempts certain critical minerals and metals used in currency and bullion from the temporary import duty. That means gold, silver, and platinum are all excluded. The U.S. Mint sells all 3. Precious metals are protected from tariffs. The very policy that is weakening the dollar and driving metals higher is not going to hurt the metals directly. Think about what that means. The headwinds for every other asset class become tailwinds for gold and silver. But here's the piece of the puzzle that changes everything for this week specifically. The Chinese markets just reopened. Chinese New Year ended. The Shanghai Gold Exchange and the Shanghai Futures Exchange were closed for over a week. And while they were closed, something was building. Implied volatility on silver going into the reopening hit 88%. 88%. That is an extreme reading. That means the market is pricing in massive moves. And here's the part that nobody in mainstream financial media is talking about. The Shanghai premium on silver was sitting at 10.5% above the London price. 10.5%. That's not a small arbitrage gap. That is a structural disconnect between what silver costs in China versus what it costs everywhere else. And markets do not tolerate that disconnect for long. When China reopens and Chinese buyers enter the market at their price, one of 2 things happens. Either the London price rises to meet the Shanghai price, or Chinese buyers buy everything in sight at the lower price until the gap closes. Either way, silver moves. And the evidence coming out of China right before the markets reopen tells you exactly which direction this is going. The largest recycling firm in Shenzhen was already offering $95.40 per ounce to buy back fine silver before the market even opened. $95.40. Silver was trading at $87.95 in the West. That recycling firm was willing to pay nearly $8 more per ounce. Do you understand what that means? That's not speculation. That's a real business making a real offer for real silver at a real price that is significantly higher than where the market is publicly trading. That is the physical market telling you the price you see on your screen is not the real price. And then there's gold. Gold shops in China have stopped selling gold entirely. They are refunding contracts. They are walking away from pre-holiday sales agreements because they believe the price is going substantially higher. These are not hedge funds. These are not algorithmic traders. These are physical gold shops that have been in business for generations. They know what they have. And they are refusing to sell it at current prices. When the merchants who deal in physical gold every single day decide to stop selling, that is one of the most powerful signals you can get. They are not selling because they believe what's coming is worth waiting for. Now let's talk about where this could go. One expert analysis circulating right now lays it out clearly. The decline in the gold-silver ratio that began in April of 2025 is tracking a pattern. If that pattern holds, the ratio could reach the levels we saw back in 2011, around 30 to 1, maybe lower. At a gold price of $7,500 per ounce and a ratio of 30 to 1, silver would be at $250 per ounce. $250. Silver is at $88 right now. That is nearly a 3 times move from current prices. And that's the conservative case. If gold reaches $8,000 and the ratio compresses to 20 to 1, silver goes to $400 per ounce. $400 from 88. Is that the base case? No. Is it possible? Absolutely. The math works. The historical precedents exist, and the macro conditions are more aligned for this outcome than they have been in over a decade. Now step back and look at the bigger picture, because this isn't just about tariffs and Chinese markets opening up. This is about something that has been building for decades. Global total debt is now at $350 trillion. $350 trillion. And it is going up every single year. Not slowing down, not leveling off, going up. There is no version of this story where $350 trillion of debt gets paid back in real money. There's no version where governments around the world suddenly become fiscally responsible. There's only one historical outcome that follows this kind of debt accumulation. The currency gets debased, the purchasing power erodes, and the people who held real assets, gold, silver, things that cannot be printed, those are the people whose wealth survives. Every fiat currency in history has eventually gone to zero. Every single one. The ones that exist today are just at different points on that timeline. And the people who understand that timeline, the people who see it for what it is, they are not waiting for permission from a bank or a government or a financial advisor to protect what they have. They are acting. Silver has just reclaimed its position as the second largest asset by market cap, sitting right behind gold. It passed Nvidia. It passed some of the largest companies in the world. That is not a minor move. That is silver asserting itself as a global monetary asset in the eyes of the market. Bitcoin is sitting at number 13 on that same list, down at $65,000. Platinum is at 28, palladium at 55. But silver is number 2, right where it should be. And the question now is whether it stays there or climbs higher as the ratio continues to fall and more capital rotates from paper assets into real ones. Think about what is happening in the world right now. Tariff wars escalating, dollar being deliberately weakened, Chinese physical buyers about to re-enter the market with a massive premium, gold shops in China refusing to sell, global debt at $350 trillion and climbing, silver passing trillion-dollar companies in market cap. Every single one of these things is a piece of the same puzzle. And the picture that puzzle makes is one of the most significant wealth transfers in modern history. It is quiet. It is not on the news. It is not being explained to you by the people who manage your retirement account. But it is happening. And the transfer does not wait for you to catch up. The transfer does not send you an invitation. You either see it while it is happening, or you look back years from now and wonder how you missed it. The people who are going to look back at this moment and wish they had paid attention are the ones who kept waiting for certainty. There is no certainty in markets. There is only positioning. There is only understanding the direction of the forces at play and deciding whether you are going to be ahead of those forces or behind them. The institutions already know. The Chinese physical buyers already know. The gold shops who are canceling their sales contracts already know. The recyclers paying $95 per ounce when the price is $88 already know. The question is what you are going to do with this information. This week could be one of the most important weeks for precious metals in recent memory. China is back. The premium is extreme. The volatility is priced in. Silver at $100 per ounce is not a fantasy right now. It is a real possibility in the very near term. Not because someone is predicting it. Because the market structure, the physical demand, the premium gap, and the macro forces are all pointing in the same direction at the same time. And let's be honest about something else that most people overlook. The The paper markets and the physical markets have been telling two different stories for a while now. The price you see on your screen, the COMEX price, the spot price, that is a paper price. It is set by contracts and futures and institutional players who, in many cases, do not own a single ounce of real metal. They are trading claims on metal, promises of metal, theoretical metal. The physical market operates differently. The physical market is where real silver changes hands in real vaults at real prices that real buyers and real sellers agree on in the real world. And right now, the physical market in China is screaming that the paper price is wrong. When a recycler offers $95 for something priced at $88 on paper, the physical market is doing the job that markets are supposed to do. It is finding the real price. And eventually, the paper market has to follow. It always does. The paper market has suppressed the price of silver before, but suppression does not last forever. It cannot. Physical demand is real, shortages are real, and when the physical market reaches a breaking point, the adjustment is fast and it is violent. The people who are positioned before that adjustment are the ones who benefit. The people who are waiting for confirmation, waiting for the news anchors to tell them it is safe, those people buy at the top and wonder what went wrong. You have the information right now. The Chinese markets are open. The premium exists. The physical shortage is real. The macro environment is driving capital into hard assets. The dollar is weakening by design. The debt is unsustainable by every honest measure. And the gold-silver ratio is telling you exactly where we are in this cycle. Under 60 and falling. You already know something's wrong with the system. That is why you are here. You already know that the people running the financial system are not managing it for your benefit. That is why you look for information outside the channels they control. You already know that wealth stored in paper promises is only as good as the promises of the people who printed that paper. And those people have a record. That record is $350 trillion of global debt and counting. The only question left is whether you act on what you know or whether you watch. History does not remember the people who watched. History belongs to the people who understood what was happening and moved when the window was open. The window is open right now. Watch this space closely. The next few days matter more than most. Drop your thoughts in the comments below. Where do you see silver and gold going from here? This is SHF Money. If you found value in this breakdown, hit the subscribe button and share this with someone who needs to see it before the window closes. Stay sharp, stay ahead, stay with us.